What truly makes a legendary investor like Warren Buffett so successful? Is it just some secret formula, maybe a stroke of pure luck, or is there something much deeper at play? A foundational philosophy, maybe, that really sets him apart. Today, we're doing a deep dive into Buffettology. The renowned investment philosophy and strategies of Warren Buffett, often celebrated as the Oracle of Omaha. And this isn't just about, the specific stocks he bought. It's more about the rigorous, almost business owner-like way he approaches every single investment decision.
Exactly. It's a mindset shift, really.
For this deep dive, we've pulled together insights from some comprehensive summaries of Buffettology, also detailed analyses of what he famously calls economic moats, and some pretty clear guides on how he actually approaches intrinsic value calculation.
Yeah, the nuts and bolts.
We'll even explore his iconic Coca-Cola investment as a kind of classic case study and balance that out with lessons learned from his acknowledged mistakes because he has made them.
Oh, definitely. And he's open about them, which is key.
Right. Plus some broader life wisdom he's shared over the decades. So our mission today is basically to distill all these diverse sources into actionable knowledge, giving you, our listener, a sort of shortcut to understanding the mind behind one of the greatest investment careers in history.
Mm-hmm.
So whether you're looking to sharpen your own investment acumen, maybe understand the mechanics of long-term wealth creation, or you simply want to appreciate a master at work, you'll definitely uncover nuggets of knowledge here that could genuinely transform your perspective.
Absolutely. You start seeing businesses differently.
Get ready for some aha moments that might just change how you see every business you encounter. Okay, let's dig in.
So where do we start? I think, what's fascinating here is how much of Buffett's unparalleled success stems not just from raw financial talent or market timing.
Which everyone seems obsessed with.
Exactly.
Oh.
But from a very particular mindset, almost a philosophy of life and business, really. It all starts with how he thinks about what he's actually acquiring when he buys a stock.
Ah, right. He sees it as owning a slice of a real enterprise, doesn't he? Not just a blip on a screen.
Precisely. And that foundational perspective, it goes right back to the roots of value investing, deeply influenced by his esteemed mentor, Benjamin Graham.
Benjamin Graham, often called the father of value investing. So what was Graham's core idea, the tenet that initially captivated young Buffett?
Well, Graham's fundamental principle was deceptively simple, but incredibly powerful: to purchase companies for significantly less than their intrinsic worth.
Intrinsic worth, okay.
He wasn't interested in fleeting trends or, market speculation. His big groundbreaking idea was the margin of safety.
Margin of safety. Explain that a bit.
Sure. Imagine you're buying a house. You've done your homework, looked at comparable sales, rental potential, a condition, and you figure out it's truly worth, say, $300,000.
Okay.
Graham would insist you only buy it if you can get it for $200,000 or maybe $220,000.
Sure.
That big discount, that difference between your calculated value and the purchase price, that's your margin of safety.
Ah, it's like a buffer.
Exactly. A crucial buffer. It protects your investment against, potential errors in your own judgment, because maybe your $300 K estimate was a bit off.
Right. Happens all the time.
Or unforeseen market downturns, or even just general bad luck. This principle was the initial, the bedrock foundation upon which Buffett built his entire investment strategy. It was about protecting your capital first and foremost. Don't lose money.
That's a powerful start. But here's where it gets really interesting, isn't it? Buffett didn't just carbon copy Graham's approach, did he? How did he, with the help of his, brilliant business partner, Charlie Munger, how did they refine and actually improve upon Graham's initial philosophy?
No, not at all. And this evolution was absolutely pivotal. Munger's influence led to a significant, almost revolutionary shift in Buffett's thinking. They came to this profound realization: it is more important to buy a good business than a cheap business.
Okay, that sounds simple, but unpack that difference. Good versus cheap.
Well, Graham's initial focus on sheer cheapness, while totally insightful for its time, sometimes led investors to acquire what Munger and Buffett would bluntly call inferior businesses, or sometimes even cigar butt businesses. One last puff left.
Cigar butts, right?
Cheap for a reason. Exactly. Companies that might be cheap for very good reasons. Think of a business selling at a bargain price, but maybe it's in a dying industry, or it has terrible management, or absolutely no real competitive edge. These cheap companies might never realize their perceived value.
Or worse.
Or worse, their value could continue to decline over time. They become a classic value trap. You think you got a bargain, but you actually bought a problem. In stark contrast, A great company, one with a durable competitive advantage, this moat idea we'll get into, will see its intrinsic value steadily increase over the long term, almost regardless of the initial price. Well, within reason.
So the focus shifts from price to quality.
Precisely. They realized that paying a fair price, maybe even a slightly higher price, for an exceptional business would yield far superior returns over decades than buying a seemingly cheap but frankly struggling or mediocre business. This was a crucial strategic shift, moving beyond just finding bargains to finding unparalleled quality and then holding on to it.
So the cost of a bad business isn't just the money lost.
No, it's the opportunity cost. It's the decades you could have spent compounding wealth in a truly great company. That's the real tragedy of buying junk just because it's cheap.
That distinction really changes the game for investors, doesn't it? So for you, the listener, what does it truly mean to think about stocks as actual businesses rather than, speculative lottery tickets? Because that seems to be a core, almost psychological part of their evolved philosophy.
Right. This mindset means engaging in a thorough, almost forensic evaluation of a company's potential profitability, its stability, and all the inherent risks involved, just as if you were literally buying the entire enterprise, lock, stock, and barrel.
You're not just looking at a ticker symbol.
Exactly. You're not just looking at a ticker symbol and a price that wiggles around all day. You're becoming an owner, not a speculator. Let's use that drugstore example again. Yeah. If you were thinking about buying your local pharmacy outright,
Okay.
you wouldn't just glance at its revenue from last month, right? You would meticulously evaluate its consistent profitability over maybe the last 5 or 10 years. You'd investigate potential market changes. Is a big chain pharmacy opening up down the street?
Yeah, competition.
Are consumer preferences shifting away from physical stores towards online? Are its core products, like certain medications or maybe household goods, still in high demand? You check its debt levels, its relationships with suppliers, the quality of its employees, the local demographics.
The whole picture.
The whole picture. And crucially, you'd calculate the expected annual return on your investment. If that drugstore was priced at, say, $1 million and its average yearly owner earnings, the cash truly available to you as the owner after keeping things running were $200,000.
That's a 20% return.
Right, a 20% annual return. Then, comparing this potential return with other alternative investment opportunities like putting your $1 million in real estate, or maybe just a safe government bond that becomes crucial for making an informed decision. One grounded in solid business fundamentals, not just hopeful speculation. That's the heart of thinking like an owner.
And this business-like, owner-centric approach, it naturally leads to another hallmark of Buffett's strategy, the power of the long-term horizon. It's such a stark contrast to, well, the common Wall Street tendency to chase swift, short-term gains, isn't it? The impatience we see everywhere.
Oh, completely. It's almost the antithesis. Buffett famously champions the buy and hold approach, especially for great businesses. The idea is elegantly simple, really. You allow the power of compounding to work its magic over years, even decades.
Compounding, the eighth wonder of the world,
You know.
supposedly.
Right. And Buffett has certainly proven its power. This means, for you, reinvesting earnings back into the business, or in the case of owning a stock, just holding on to those investments for extended periods, letting your capital grow exponentially. His famous line that his favorite holding period is forever truly encapsulates this philosophy.
Not literally forever, maybe, but
Not literally, no, but it's a mindset. If you're buying a truly great business, why would you ever want to sell it unless its fundamentals significantly deteriorate? Or perhaps if you find something demonstrably better.
right.
So for you, the listener, this connects directly to personal wealth building. True. Sustainable wealth isn't typically built on day trading or chasing the latest hot stock tip you heard somewhere.
No quick fixes.
Exactly. It prioritizes patience, discipline, long-term commitment, and letting your money consistently work for you over decades. It's like planting an oak tree, not trying to harvest radishes every week.
I like that analogy. It also means less stress, right? Not watching the market every minute.
Absolutely. It frees up mental energy and reduces a ton of stress. You focus on the business, not the daily stock price flickers.
Now, let's pivot to Buffett's favorite metaphor, the one that conjures such a vivid image, the economic moat. It's so central to his thinking. For those who haven't heard it explained this way, what exactly is it in the business world, and why is it so critical for long-term success?
Right, the economic moat.
Yeah.
It draws this really evocative parallel with, the water-filled trenches that protected medieval castles from invaders.
Keeps the bad guys out.
Exactly. Imagine those deep, wide moats, making it incredibly difficult for an attacking army to even reach the castle walls. In the business world, an economic moat is a sustainable competitive advantage that shields a company's profits and its market share from marauding competitors.
Marauding competitors, I like
It's
that.
what separates the consistently successful, highly profitable firms from those that fail or just, barely get by in the cutthroat marketplace.
And you mentioned consumer monopoly earlier. How does that fit in?
Yeah, a consumer monopoly, specifically, highlights a type of dominance driven by strong consumer goodwill. This often comes from things like superior products people love, really effective advertising campaigns that cement a brand in the public mind, or just sheer convenience that makes a product or service feel almost indispensable.
Like you can't imagine life without it.
Kind of, yeah. As Buffett himself put it, beautifully, I think. We're trying to find a business with a wide and long-lasting moat around it, surrounding and protecting a terrific economic castle, with an honest lord in charge of the castle.
Ah, the honest lord part is key too. We'll get back to that.
Absolutely. But the metaphor just underscores the absolute importance of a business being able to protect its market share and profitability over the long haul, not just for a year or two.
So how do companies actually construct these formidable defenses, these moats around their economic castles? What are the different forms they can take? Can you give us some tangible examples?
Sure, there are several powerful, distinct ways companies build and maintain these competitive fortifications. Different kinds of barriers to entry for rivals. One major type is cost leadership. Being the absolute low-cost producer in an industry allows a company to either undercut competitors' prices while still making good money, or to charge similar prices but enjoy significantly higher profit margins.
Like Walmart.
Walmart's the classic example. Their moat isn't just about offering low prices, it's how they achieve them. They have these incredibly efficient supply chains, massive economies of scale letting them buy in huge bulk at lower costs, and sophisticated logistics that minimize waste. It's really, really hard for a smaller competitor to replicate that cost structure.
Okay, so low cost is one. What else?
Then there's brand strength. And this isn't just about a cool logo. It's about a powerful position in the consumer's mind that commands premium pricing and often fierce customer loyalty.
Like Coca-Cola, Apple, Nike.
Exactly those. Their brands are so powerful that consumers globally will actively choose them over less expensive or maybe less well-known alternatives. And this isn't just fancy advertising, though that helps. It's often a deep-seated trust and emotional connection built up over decades,
Oh.
often from a combination of consistent product quality people rely on, making it available everywhere, convenience, having courteous service, and yes, exceptionally effective advertising, sometimes even a legendary secret formula, like with Coke. That trust is incredibly difficult and expensive for a new competitor to try and build from scratch.
Okay, brand power. What's next?
Service that breeds loyalty. Companies like Amazon, for instance, have built enormous moats, partly through just superior customer service. Their reputation for fast shipping, super easy returns, customer-centric policies, it creates a high switching cost in a way.
Yeah, once you're used to Prime, it feels like a pain to shop elsewhere.
Right, that's the point. That kind of consistent, reliable service builds incredible customer stickiness. It's a hassle to leave.
Makes sense. Technology must be one too, right?
Oh, absolutely. Technological edge is critical. Leveraging proprietary technology, unique algorithms, or maybe patents. Alphabet's constantly refined search algorithm for Google search, for example. That gave it an advantage that's been incredibly hard for competitors to match, despite decades of trying.
And all the data they have.
And the underlying infrastructure and vast data sets.
Ah,
Yeah. Though it's worth noting, the recent rapid rise of AI, especially large language models, has shown some potential chinks in Google's armor, maybe. It illustrates that even the strongest moats can evolve and face new, disruptive challenges.
so even giants have to keep innovating.
Constantly, it forces them to.
Okay, what else builds a moat?
Well, moving on, companies also leverage intangible assets like patents, trademarks, and regulatory licenses. Think about pharmaceutical companies. They rely heavily on patent protection.
Right, for new drugs.
Exactly. Developing a new drug can cost billions and take over a decade. So a patent provides a temporary monopoly, allowing them to recoup those massive R&D investments and generate profits before generic competitors can jump in. Without that patent moat, the incentive to innovate would largely disappear.
Got it.
Well,
What about just being big?
Yep, that's economies of scale. Sometimes simply being large can, in itself, create a moat. When a firm reaches a certain size, it can produce more units at significantly lower input costs per unit.
Cheaper materials.
It's not just buying raw materials cheaper, though that's part of it. It's also about spreading fixed overhead costs, things like financing, advertising, R&D, across a much larger revenue base. This sheer efficiency allows large companies to dominate market share and outcompete smaller rivals who just can't match their operational leverage.
Okay, scale helps. Anything else?
Switching costs? This is another powerful defense. This happens when it's expensive, difficult, in terms of money, time, or just plain effort for customers or even suppliers to move to a competitor.
Like changing banks.
Yeah,
Or my phone provider.
exactly. Or think of enterprise software like Oracle or maybe Microsoft's whole ecosystem. Once a company invests millions in customizing and integrating a complex software system, the cost and massive disruption of switching to a new vendor become enormous. It makes those relationships incredibly sticky.
Hard to leave.
Very hard. And finally, there are network effects. These create a truly powerful, self-reinforcing advantage. This happens when a product or service becomes more valuable as more people use it.
Like social media.
Social media platforms like Facebook or professional networks like LinkedIn are classic examples. The more users they have, the more valuable they become to each individual user because there are more connections, more content, more opportunities. This creates a virtuous cycle that makes it exceedingly difficult for new competitors to gain a meaningful foothold because they start with zero users.
The first user has no one to talk to.
Pretty much. It's a tough barrier to overcome.
So it's clear that building a moat is essential. But is simply having a moat enough? Or does its resilience, its durability matter just as much, if not more? Because it feels like the business landscape is littered with once powerful companies whose moats just, well, dried up eventually.
You've hit on a crucial point there. Buffett emphasizes over and over that most moats aren't worth a damn if they aren't durable. The true value lies not just in the moat itself, but in how long it can genuinely withstand competitive pressures and disruptive forces.
So how do you assess durability?
Well, key factors include longevity. Will this advantage realistically last for 5, 10, or even 20 years? What are the specific key factors that actively maintain it? And how permanent are those factors in a dynamic, ever-changing economy?
And management plays a role here too.
Critically, you have to look at management dependence. Does the moat rely too heavily on the unique genius or relationships of the current leadership? If the CEO leaves, does the whole thing crumble? And, tying back to the honest Lord, management integrity, will the leaders exploit the moat for short-term personal gain, maybe make poor, short-sighted decisions that ultimately squander it?
Because moats aren't permanent defenses.
No moat is truly impregnable forever. Buffett understands that markets, technologies, consumer preferences, they constantly shift.
Yeah.
Just like medieval moats eventually became obsolete with new warfare technologies like cannons, a company's competitive advantage can erode due to innovation, new business models, changing consumer habits, you name it.
So the challenge is constant.
Absolutely. The challenge for companies is to continually widen and deepen their moats. It's almost like an ongoing arms race to stay ahead.
Looking back at Buffett's investment choices and his, well, astounding track record, what specific types of consumer monopolies have consistently proven successful for him over the decades? Are there clear patterns that emerge when you look at his portfolio?
Oh, definitely. By examining his portfolio, especially his most successful long-term holdings, we can sort of unveil 3 distinct categories of consumer monopolies that have consistently delivered for him.
Okay, lay them out for us.
The first category includes businesses producing rapidly consumed or perishable products. These are companies with such significant brand recognition and consumer loyalty that they basically compel merchants from the little corner store to the giant supermarkets to carry their products or risk losing business.
Coca-Cola being the prime example.
Coca-Cola is the quintessential example, yes.
Hmm.
Another historical one, though controversial now, was Marlboro cigarettes. These products are often consumed quickly, requiring constant repeat purchases. And once established, they often require minimal continuous updates or massive R&D investments compared to, say, tech companies. This leads to consistently higher profits and strong, predictable cash flow. Their power lies in being deeply ingrained in daily life.
Okay, consumables with strong brands. What's the second category?
The second category features communications businesses that play a vital, almost indispensable role in product advertising. Think traditional TV networks, radio stations, maybe even advertising agencies themselves historically.
Why them specifically?
Well, they provide the essential channels for manufacturers to showcase their products and reach customers. And since advertising is a constant necessity for basically any business looking to grow or just maintain market share, manufacturers become reliant on these communications companies. This made them incredibly secure investments, often with excellent pricing power, because they controlled access to the audience.
Hmm, interesting. And the third category.
Lastly, the third category highlights businesses providing repetitive consumer services that are consistently in demand. These are often somewhat mundane, but absolutely necessary services that individual consumers or small businesses need on a regular basis.
Like cleaning services or
Right.
tax prep.
Exactly. Examples like Service Master for cleaning and pest control or H&R Block for tax assistance fit this mold. These firms often rely on scalable models, sometimes utilizing low-skilled, non-unionized temporary workers, which can result in reduced operating expenses and increased profits. They keep profits flowing generously with relatively minimal ongoing capital expenditure once the initial setup is done, because the service itself is a recurring need. They're not flashy, but they are incredibly consistent cash generators.
That's a great transition from identifying what kind of businesses he likes to how Buffett actually values them. Because his approach isn't always what you'd find in a standard finance textbook, is it? What's his unique take on, say, earnings per share, and how does that connect to the price you ultimately pay for a stock?
Right. Well, earnings per share, or EPS, is undoubtedly a crucial factor in most stock evaluations. Buffett's perspective on it is quite unconventional and really sets him apart. He places a heavy emphasis on trusting company management to effectively retain earnings and reinvest them wisely back into the business. He wants them to generate genuine long-term capital growth.
Like Berkshire Hathaway itself does.
Precisely. Berkshire rarely pays out dividends. Earnings are reinvested. So Buffett cares less about the reported EPS number in isolation and much more about what management does with those earnings. Are they squandering it on foolish acquisitions or pet projects, or are they compounding it intelligently within the business?
And the price paid is key.
Absolutely critical. He consistently highlights that the price you pay for a stock directly determines your potential rate of return. You can buy shares of the best company in the world, but if you paid a ridiculously exorbitant price, your returns are going to be mediocre, maybe even negative.
Makes sense.
Conversely, a good company bought at a great price can yield phenomenal returns over time. So, by analyzing a company's underlying earnings power and, crucially, management skill in allocating that capital, you can make informed predictions about future earnings. And that, in turn, enables you to buy stocks at a price that maximizes your potential for optimal long-term returns. It's not just about what a company earns, it's about what management does with those earnings and what you pay to get a piece of that action.
Okay, let's unpack this really core concept then. Intrinsic value. It's absolutely fundamental to Buffett's philosophy. How does he actually define it, and why does he consistently say it's not some simple, straightforward calculation? More of an art than a science.
He defines intrinsic value quite simply, conceptually at least, as the discounted value of the cash that can be taken out of a business during its remaining life.
Okay, the cash you can pull out over its lifetime.
Exactly. Think of it as the total economic benefit you, as an owner, could extract from that business from today until it eventually ceases to exist, all discounted back to today's dollars. However, and this is the crucial part, he stresses that it's fundamentally an estimate. It is not a precise figure you can calculate down to the penny.
Not like a physics equation.
Not at all. And it's an estimate that must be continuously adjusted for changing interest rates or revised cash flow forecasts if the business outlook changes, or maybe new competitive threats emerge.
So it's dynamic.
Very dynamic. He's even noted that two highly intelligent people looking at the exact same set of facts, even he and Charlie Munger, will almost inevitably come up with slightly different intrinsic value figures.
Yeah.
He views valuation as far more of an art form than a pure science. It requires a significant degree of judgment.
So you have to be reasonable.
It demands you be reasonable in your cash flow and growth rate estimations, always knowing that perfect foresight is totally impossible. The more conservative and, importantly, the more knowledgeable you are about a particular company and its specific industry, the more accurate and reliable your approximation of intrinsic value is likely to be. It's about getting into the right ballpark, not hitting a precise number on the head.
So given that it's all about cash flow, what's the specific cash flow measure Buffett prefers to use? Because you hear about free cash flow, operating cash flow. How does his measure differ from what others might typically use? It sounds like he has a very particular way of looking at it.
He absolutely does. Buffett introduced and prefers what he calls owner's earnings. This is essentially the amount of cash a business actually generates for its owners that could, theoretically, be distributed like through dividends or used to reduce debt or be reinvested back into the business without needing to raise any additional outside capital. It's the truly discretionary cash flow.
Okay, so how is it calculated? Is it complicated?
The original comprehensive formula he gave was reported earnings, so net income, plus depreciation, depletion, amortization, and any other non-cash charges you find on the income statement, minus the average annual amount of capital expenditures, CapEx, that are required just to fully maintain the business's long-term competitive position and its current unit volume.
Okay, so net income plus non-cash charges minus maintenance capex.
Exactly. It's essentially about what's left for the owners after keeping the business running as is, not including what's spent on expansion or growth.
Can that be simplified? That sounds a bit tricky to calculate.
Yeah, it can often be simplified and probably more accurately for most people to operating cash flow minus maintenance capital expenditures.
Operating cash flow minus maintenance capex. Why is that often better?
Well, operating cash flow comes straight from the cash flow statement and is less susceptible to the accounting manipulations that can sometimes affect reported net income. And again, the key is subtracting only maintenance capex.
Right. You keep stressing that distinction, maintenance versus growth capex. Why is that so critical?
It's absolutely crucial for you, the investor, to understand this difference. Maintenance capex is the money spent just to maintain normal operations. Think of it as fixing a leaky roof on the factory, replacing old worn-out machinery, or keeping existing software licenses up to date. It's basically the cost of staying in business at the current level.
Got it. Keeping the lights on.
Exactly. Growth capex, on the other hand, is money spent specifically to reinvest and grow the business. That's things like building a brand new factory, expanding into new geographic markets, or developing a revolutionary new product line.
But how do you figure out which is which? Do companies report it separately?
That's the tricky part. Most companies don't explicitly break out maintenance capex versus growth capex in their standard financial statements. This means individual investors often have to estimate it.
How? Any rules of thumb?
Well, there are a few ways. A common, somewhat conservative approach is to look at the company's depreciation and amortization figures from the income statement. You can use that as a rough proxy for maintenance capex, as these figures often represent the historical cost of assets being used up or becoming obsolete in the business each year.
Okay, use DNA as a substitute.
Or you could analyze a company's historical total capital expenditure trends in relation to its revenue growth. If capex generally rises in proportion to revenue growth, it suggests a significant portion is likely growth capex, aimed at supporting that expansion. If revenue is flat but capex is still significant, maybe more of it is maintenance.
So you need to dig deeper.
Yeah, you might need to read detailed company reports, listen to investor calls, look for management's discussion of how they're allocating capital. It takes more work. This distinction makes owners' earnings a more precise, though definitely harder to find, measure than simple free cash flow, which typically just uses total capex, lumping maintenance, and growth spending together. Buffett wants to know what's truly available for him as an owner after the business is taking care of its basic needs.
Okay, so once we have a handle on these owners' earnings, which, yeah, sounds like a much purer measure of the cash flow actually available to shareholders, how do we project their future growth? Does Buffett pull out some secret algorithm or a crystal ball for that part?
No, absolutely no secret formula or mysterious algorithm involved. Buffett's approach here emphasizes a deep, thorough, and almost obsessive understanding of the company itself and its specific industry.
So back to understanding the business.
Always back to understanding the business. This includes truly grasping the underlying drivers of its revenues and expenses. What makes them go up or down? What current initiatives is the company undertaking to actually drive growth? What's the quality and, importantly, the integrity of the company's management team? Are there broader consumer or industry trends that could impact demand for its products or services? And, critically, how strong and durable is its economic moat? For him, forecasting growth isn't primarily about plugging numbers into a spreadsheet. It's about understanding the whole story of the business.
Okay. But what about for us, mere mortals, individual investors who maybe don't have Buffett's analytical prowess or the time to do that deep dive on every company?
Well, for individual investors who may not have that deep level of competence within a particular industry or company, and let's be honest, very few of us can match Buffett's skill here. His advice is pretty clear. The best option is to just be conservative and to focus on simple businesses that you can understand.
The circle of competence idea.
Exactly. If you can't explain how a company makes money and why it has an edge in a simple sentence or two, you probably shouldn't be investing in it. Stick to what you know.
Practically, though, if we're trying to put a number on growth, what can we use?
Practically, investors might look at historical owners' earnings growth rates, or maybe free cash flow growth rates if owners' earnings are too hard to estimate, perhaps using a 5-year or 10-year average. You could even use net income growth rates as a rough proxy, though with caution.
But adjust them downwards.
Always. You should always apply your understanding of the business and industry to potentially reduce aggressive historical rates for a more conservative future valuation. For example, if a company has somehow managed to grow its cash flow at, say, 20% annually for the last 5 years, but you know its industry is maturing or facing new competition, you might project a much more conservative 8% or 10% growth rate for the future. The key is to be realistic and, above all, conservative. Optimism is often the enemy of a good valuation.
After projecting these future cash flows, how do we then discount them back to the present? That's the next step, right? What's Buffett's preferred discount rate, and why does he use that specific benchmark?
Right. This is where the fundamental concept of the time value of money comes into play. The basic idea that a dollar today is worth more than a dollar you expect to receive in the future because you could invest today's dollar and earn a return on it.
Okay, so what rate does Buffett use?
Buffett's preferred discount rate, historically, has been the U.S. 10-year Treasury rate. He sees this as representing a long-term, risk-free rate, essentially, the return you could get on an investment with virtually no risk of default, backed by the full faith and credit of the U.S. government.
The safest investment around, theoretically.
Theoretically, yes. Now, he's also noted that if this rate is on the low side, for example, maybe around 2.5%, as it has been at various times in recent history, he might mentally adjust it upwards by a point or two, perhaps to 3% or 4%.
Why would he do that? Adjust it higher.
To make his valuation more stringent and conservative. Think about it. Lower discount rates lead to higher present valuations for future cash flows. If the risk-free rate is super low, almost any stream of future cash flow looks valuable today. By nudging his required rate up slightly, he ensures he's only valuing companies that offer a truly compelling expected return above that baseline safe rate.
So it sets a higher hurdle.
Exactly. His approach basically implies there's no difference in economic reality between a stock and a bond, except for one crucial thing. A bond tells you its future cash flows precisely, while with a stock, you have to estimate those future cash flows, which is much harder, but potentially far more rewarding if you get it right.
Okay, but using the 10-year Treasury rate seems specific. What about for individual investors? Is there an alternative?
Yeah, for you, the individual investor, a simpler and often perhaps more relevant alternative is to use your own personal required rate of return as your discount rate.
My own target return.
Right. This could be, say, a static 10%, which is roughly the historical long-term average annual return of the S&P 500 index. Or maybe you want a higher rate, say 15% or even more, especially if you're younger and have a longer time horizon, or if you're evaluating riskier assets. This personal rate means you don't have to constantly track or adjust for the daily ups and downs of the 10-year Treasury yield.
And using a higher rate means?
Naturally, if you require a larger rate of return from your investments, the company you're analyzing will be worth less today in your valuation model. This means you'd need a lower entry price to meet your hurdle rate.
Which increases potential upside and decreases downside risk.
Precisely. Higher personal discount rates force you to be more selective, demanding a bigger margin of safety upfront, which is generally a good thing for long-term results.
Since we can't reasonably project a company's cash flows indefinitely, like for the next 100 years, how do we account for the value of the business beyond our typical forecast period, say, beyond year 5 or year 10? This seems like a pretty critical piece of the overall valuation puzzle.
Absolutely. It's a huge piece. That's where the concept of terminal value, often abbreviated as TV, comes in. Terminal value is the estimated value of the business after your initial explicit forecast period, which, as you said, might be 5, 10, maybe even 15 years, because projecting individual cash flows reliably gets way too speculative much further out than that.
So TV captures everything after the forecast.
Essentially, yes. Terminal value captures the present value of all the cash flows that the business is expected to generate beyond that forecast horizon, assuming it continues to operate indefinitely, or at least for a very long time.
How do you calculate it? Is there a standard way?
The preferred, most common method for calculating terminal value is the perpetuity growth method, which is also known as the Gordon growth model.
Okay, the Gordon growth model. How does that work, roughly?
Roughly, the formula calculates the future value of the terminal value first. You take the free cash flow, or owner's earnings. You projected for the very last year of your explicit forecast period, say year 10. Then you grow that final year's cash flow by one more year using your assumed terminal growth rate. Let's call it G. Then you divide that result by the difference between your discount rate, let's call it R, and that terminal growth rate, G. So it's FCFN N1 plus G.
Okay, FCF times 1 plus G divided by R minus G. That gives you the value way out in the future.
Right, that gives you the estimated value of the company at the end of your forecast period, say at the end of year 10. Then you still need to discount that future terminal value figure all the way back to its present value today, using your chosen discount rate, R.
Got it. Are there any important rules about that G, the terminal growth rate?
Yes, a critical condition for this method, which sometimes gets overlooked, is that the terminal growth rate, G, must be smaller than your discount rate. Mathematically, if G were larger than or equal to R, the denominator RG would be 0 or negative, and the formula would blow up, implying infinite value, which isn't realistic.
Makes sense. And how high should G be typically?
Well, and this is really important for realism, G should generally be a conservative figure. Often, it's assumed to be below the expected long-term growth rate of the overall economy, like the U.S. GDP growth rate. So typically somewhere between 1% and 3% is common.
Or even 0.
Or even 0% growth in perpetuity. That's a perfectly viable, very conservative option. It just means you assume the business maintains its current earnings power indefinitely without any further growth after your forecast period. For example, even if you project hundreds of millions in cash flow in year 10, that terminal value, once discounted back to the present, could still represent a significant chunk, sometimes more than half of the company's total calculated intrinsic value today. It accounts for the business's ongoing value beyond your explicit forecast, a really big piece of the puzzle for a true long-term investor.
So bringing all these different components together, the owner's earnings, the projected growth rates, the discount rates, and this terminal value piece, what does this all mean for actually arriving at a final intrinsic value number for a company? How do these pieces fit into the bigger picture of valuation?
Right, so we typically combine all these components using one of two primary methods. Both are really trying to answer the same fundamental question. Based on its expected future cash flows, what is this entire business truly worth today?
Okay, what's the first method?
The standard, most comprehensive method is Method 1, discounted cash flow, DCF valuation. This method simply sums the present values of two main components. First, you take the present value of all the projected owner's earnings, or free cash flows, for your explicit forecast period, say for the next 10 years, growing at your estimated rate each year.
Okay, the PV of the first 10 years of cash flow.
Exactly. And second, you add the present value of the terminal value that we just discussed, which accounts for the business's estimated value beyond that initial 10-year forecast period.
So PV of forecast cash flows plus PV of terminal value equals intrinsic value.
That's the essence of a DCF. For instance, if you were to meticulously perform a DCF analysis on a large, stable pharmaceutical company, maybe using conservative growth rates and Buffett's preferred lower discount rate like the adjusted 10-year Treasury, you might find that its calculated intrinsic value per share comes out significantly higher than its current trading price in the stock market.
And that would signal.
That would imply the stock was very undervalued according to these strict metrics, suggesting a potentially compelling buying opportunity. The DCF model is robust. But remember, it's highly sensitive to all those input assumptions. Growth rates, discount rates, terminal value.
Garbage in, garbage out, basically.
Exactly, which is why conservatism is key.
Okay, so DCF is the main method. What's the second one you mentioned?
Method 2 is the present value growing annuity, PVGA method. This is a decidedly more conservative approach because it makes a very strong assumption. It assumes the company's value after the forecast period is essentially 0. It doesn't factor in any terminal value at all.
Wow, okay. So just the value of the cash flows during the forecast period.
Precisely. This might be appropriate if you're valuing a company in a highly volatile or uncertain industry, where predicting the long-term future feels exceptionally risky, or maybe if you just prefer an ultra-conservative stance as an investor.
So using that same pharmaceutical company example.
For that same pharma company, using the PVGA method with the exact same inputs for the forecast period, you might still find the company undervalued against its current stock price, but likely less dramatically than with the full DCF model because you've excluded that potentially large terminal value component. Both methods can provide valuable insights, but PVGA offers a more stringent, often arguably safer valuation floor, forcing you to find even deeper discounts relative to your estimate.
Given the sheer number of assumptions involved in all these calculations, I mean, projecting earnings, picking growth rates, choosing discount rates, even just estimating maintenance capex, how does Buffett himself account for the inherent uncertainty and the, frankly, unpredictable nature of the future? It seems like it would be incredibly easy to be off by a lot.
You're absolutely right. Precision is really an illusion in investing, especially when looking years into the future. He accounts for this massive uncertainty through two critical, closely interrelated practices that act as powerful risk mitigators.
Okay, what are they?
First, he employs scenario analysis. This is absolutely vital for adjusting for possible mistakes in your future predictions, and, maybe more importantly, for understanding the range of potential outcomes, not just a single point estimate.
How does scenario analysis work?
It involves creating at least three distinct scenarios, usually a worst case, a best case, and a normal case or base case scenario. You do this by systematically varying your key input assumptions, things like the growth rate of owners' earnings, your chosen discount rate, or maybe the assumptions behind your terminal value calculation, and then you assess the impact on the calculated intrinsic value for each different scenario.
So you see how sensitive the result is to changes.
Exactly. For example, if your normal DCF analysis suggests a stock is significantly undervalued, but your worst-case scenario may be assuming much lower growth and a higher discount rate shows it's only fairly valued or perhaps even overvalued, that tells you there's less margin for error in your base case. It helps you understand a range of probable outcomes rather than relying on a single, potentially misleadingly precise figure. You might find, for instance, that changing your discount rate by just 1 or 2 percentage points can swing a company's calculated intrinsic value by hundreds of millions or even billions of dollars. That really illustrates the sensitivity of the model and highlights the need for understanding the range, not just the point estimate.
Okay, scenario analysis is one tool. What's the other?
The second, and perhaps the most fundamental principle of all, is applying the margin of safety. This is the concept he learned directly from Benjamin Graham, and it's arguably the single most important concept in all of value investing.
Back to Graham's core idea.
Right back to the beginning. It simply means buying a business for significantly less than your most conservative calculation of its intrinsic value. For example, buying a business you genuinely believe is worth $100 for only $70, or maybe even just $50 if you can find it.
That built-in cushion.
Precisely. That substantial buffer protects you against, well, almost everything. Errors in your own judgment, because your $100 valuation might be wrong, unforeseen negative events that impact the company, like a recession or a new competitor, or the company simply underperforming your expectations for whatever reason. By building in this cushion, you dramatically reduce your downside risk.
How big should the margin of safety be?
That depends. It depends on your confidence in your valuation and also the discount rate you're using. For Buffett's typically lower discount rates, he might demand a very large margin of safety, maybe 50% or even more, meaning he'd only pay $50 for that business he values at $100. If you're using a higher personal required rate of return, say 15%, maybe a 15-25% margin of safety below your calculated intrinsic value might suffice, because your higher discount rate already builds in some conservatism. This cushion not only protects your initial capital, but also creates a statistical likelihood of achieving returns higher than your target discount rate if things go reasonably well. It's an absolutely indispensable tool for navigating uncertainty and ensuring that even if you're partially wrong in your forecast, you're still likely to come out okay or even well ahead in the long run.
You mentioned the honest lord in charge of the castle earlier when we were talking about moats. How absolutely crucial is the quality and, maybe just as importantly, the integrity of management to a company's moat and its overall long-term success? It feels like management could make or break even the best underlying business.
Oh, it's profoundly crucial. In fact, Buffett considers it one of the most vital, if not the most vital, qualitative factors he assesses. He understands deeply that even the widest, strongest economic moat, that powerful competitive advantage we talked about, can be completely squandered by poor leadership decisions, bad capital allocation, or unethical behavior. And conversely, exceptional management can actually reinforce existing moats, maybe even create entirely new ones through smart strategy and execution. He famously seeks managers who act as rational, honest, financial stewards of the owner's capital, people who think like owners themselves.
Are there different management styles he looks for or avoids?
Well, we can identify different management styles and think about their direct impact on a company's moat. For instance, visionary leadership might allow companies to anticipate future trends and position themselves accordingly, potentially creating new technological or brand moats. Think maybe Steve Jobs at Apple in his second run. Operational excellence focuses relentlessly on efficiency and cost management, which can build formidable cost-based moats, maybe like Southwest Airlines' consistent low-cost model over decades.
What about customer focus?
Right. Customer-centric management prioritizes customer satisfaction above all else, which can create incredibly strong service-based moats and loyalty, maybe like Nordstrom historically built its reputation. Then there's innovation-focused leadership, which ensures continuous progress in products and services, sustaining a technological or brand moat long-term. Think maybe 3M with its culture of innovation. And finally, and perhaps most important for Buffett, is financial stewardship managers who wisely allocate capital, reinvest retained earnings back into the business only when they expect high returns, avoid dumb acquisitions, and generally protect and grow the shareholders' capital over time.
Has Buffett talked about bad experiences with management?
Oh, definitely. He's certainly had his share of experiences with both exceptional managers and, well, problematic ones. He once lamented about a textile business he bought early on, where he inherited a manager who insisted on pouring capital into a dying division, almost destroying the entire company despite Buffett's warnings. On the absolute other hand, his long partnership with Charlie Munger, who constantly pushed him towards investing in truly great businesses run by great people, is a testament to the power of excellent leadership and intellectual integrity working together. Ultimately, a strong moat without an honest, capable lord or lady to protect and manage the castle is really just a recipe for eventual disaster. The people running the show are the ultimate guardians, or sometimes the destroyers, of long-term shareholder value.
Okay, here's a fascinating tactical nugget that I think many people overlook when they study Buffett. His early and very clever use of other people's money, often just abbreviated as OPM. He didn't exactly start out wealthy. How did he leverage this concept to build his empire and really supercharge his returns, especially early on?
Yeah, it's a brilliant and often underestimated part of his story, and it really reveals his strategic genius beyond just being a great stock picker. Buffett definitely didn't start with vast personal sums of capital. His initial approach to using OPM was through his early investment partnership, which he started in the mid-1950s. He gathered money mostly from family and friends initially.
How did that work?
He had a fee structure where he took a pretty healthy 25% cut of all the annual returns above a fairly modest 6% hurdle rate for his partners, but he took no base management fee. This structure incentivized him heavily to perform well, and it allowed him to manage significant amounts of capital and compound his own wealth much, much faster than if he'd only been investing his relatively small personal savings at the time.
So the partnership structure was key early on, but then came the insurance business, right?
Right. His most brilliant and enduring move in leveraging OPM was the strategic acquisition of insurance companies, starting with National Indemnity and then famously Geico, beginning in the 1960s and continuing over the years. Here's the magic of insurance from an investment perspective. Insurance companies receive payments from policyholders up front. These are called premiums. You pay your car insurance monthly or maybe every 6 months.
Right, you pay before you crash, hopefully never.
Exactly.
Yeah.
But the insurance company only pays out claims sporadically, often much, much later, if they ever have to pay out at all on your specific policy. This means insurance companies are constantly sitting on the gigantic pile of idle cash for extended periods before they might have to pay it out. This pool of money is known as insurance float.
Float. Okay, so what did Buffett do with this float?
He masterfully used this float, which is essentially interest-free capital, or sometimes even better than free if the insurance operations themselves are profitable, to massively increase the amount of money available for investments within Berkshire Hathaway. Instead of needing to borrow money from banks at high interest rates, or issue new Berkshire stock, which dilutes existing shareholders, to fund his acquisitions of businesses or large stock positions, he had access to billions, and eventually tens and hundreds of billions, of dollars of stable, low-cost, often negative cost, capital. He could then deploy this float into purchasing more wonderful businesses or stocks that met his strict investment criteria.
Wow, so it's like getting paid to hold money you can invest.
Pretty much, if the underwriting is profitable. This drastically boosted his absolute returns over decades because he didn't have to pay interest on a huge portion of the money he was investing. Some people argue, quite persuasively, that this structural advantage, having access to cheap, consistent, growing capital from the insurance float, essentially other people's money that he could use almost at his discretion, was as critical to Berkshire's long-term success and compounding power as his legendary stock-picking acumen. It was a true masterstroke of financial architecture.
Beyond balance sheets and discounted cash flows and insurance float, Buffett's wisdom seems to extend far beyond just financial statements. What are some of his key life lessons that seem to resonate so strongly with his investment philosophy? Almost like they echo the same core principles, but in a different domain.
Oh, absolutely. His life lessons are indeed profound, and they align almost perfectly with his investing principles, showing this remarkable consistency of character and thought. He often emphasizes the idea of the compounding of good intentions.
Compounding of good intentions, how does that work?
He advises surrounding yourself with smart, inspiring people from whom you can learn. People who genuinely make you better just by being around them. And crucially, he stresses the importance of reciprocating helpfulness and kindness. As he puts it, you get a compounding of good intentions and good behavior, and unfortunately, you can get the reverse of that in life too. This idea of positive reinforcement and consistent positive collaboration with good people directly mirrors the long-term exponential compounding of returns you see in successful investing. It's all about building positive habits and positive feedback loops, whether they're financial or personal.
Interesting parallel. What else?
He also champions finding purpose in profession. He advises people, especially young people, to choose a profession they would pursue if you didn't need the money. He emphasizes that true fulfillment and happiness often come from doing meaningful work you love, not just from chasing the next paycheck. He also strongly warns against associating with people who tell you to do something that you shouldn't be doing, highlighting the critical importance of maintaining your integrity, your own self-direction, and a strong moral clarity in all aspects of your life.
And he reads a lot, right?
Famously, for aspiring hires at Berkshire Hathaway, his simple advice is often just to keep a lot of curiosity and read a lot. He reportedly spends 80% of his day reading even now, underscoring lifelong learning and continuous intellectual growth, and absolutely fundamental to success in any field, especially investing. You simply must constantly learn and adapt to a changing world.
And how does this broader life wisdom connect back to financial health for the listener?
Well, these broader life principles, things like practicing responsible spending through budgeting and maybe reducing unnecessary expenses, or diligently building financial stability with an emergency fund, or paying off high-interest consumer debt. They create the essential foundational ground for any successful long-term investing, regardless of your specific strategy.
You need a solid base first.
Exactly. You can't really be a patient, rational, long-term investor if your personal finances are constantly in chaos or causing you stress. These habits establish the discipline, the foresight, and the peace of mind that are necessary to take advantage of investment opportunities when they arise, rather than being forced to sell at the worst possible time because you need the cash. It's really about building a robust life overall, which then provides the stability to support robust long-term investing.
Let's shift now to a really concrete example of Buffett's principles in action. What made his Coca-Cola investment so legendary? It feels like a true textbook Buffett investment that perfectly illustrates his whole philosophy.
Oh, the Coca-Cola investment is fantastic because it perfectly illustrates almost every facet of his philosophy coming together beautifully. Buffett started accumulating Coca-Cola shares back in 1988. Now, that was a period when the company was actually still recovering from the infamous New Coke debacle.
Yeah, that was a huge marketing blunder.
Huge. And crucially, partly because of that recent stumble, its stock was arguably undervalued by the market at that time. Buffett saw immense long-term value where many others saw mainly risk and short-term challenges from that episode. His initial investment was roughly $1 billion, which acquired approximately 7% of the entire company back then. That stake has since ballooned to be worth well over $20 billion today, and that's excluding the truly substantial dividends he's collected year after year for over 3 decades.
Wow, so what did he see that others missed?
It was just a quintessential Buffett move. He recognized Coca-Cola's utterly unassailable brand. I mean, it's a product that appeals to billions of people globally. It's almost a universal symbol. He saw its vast global distribution network, which would be nearly impossible and incredibly costly for any competitor to replicate from scratch. And he understood the unwavering consumer demand for its core product. People just keep running your Coke, day in and day out, recession or boom.
So a classic consumer monopoly.
Exactly. A classic consumer monopoly in action. A business with highly predictable earnings, incredible pricing power due to that intense brand loyalty, and at the time he bought it in '88, it was available at a discount relative to his estimate of its long-term intrinsic value.
And the results speak for themselves.
Astounding results. From 1988 through 2020, for example, the investment consistently outpaced the broader market. It yielded an annualized return of about 10% from the stock price appreciation alone, excluding those hefty dividends, compared to the S&P 500's average of about 7.8% over that same very long period. This massive success deeply affirmed his core strategy. Focus on a company's fundamental intrinsic value, its durable moat, and its long-term potential, rather than getting caught up in short-term market noise or recent company hiccups.
Did his investment have an impact beyond just Berkshire's returns?
Yeah, interestingly, Buffett's huge investment also served as a significant public endorsement of Coca-Cola. It bolstered the company's credibility during a period when it was still shaking off the new Coke mess, and it likely influenced the broader market's perception of Coca-Cola's true, enduring intrinsic value. It was a powerful signal to the world that patience, quality, and brand power truly pay off in the long run.
But as you mentioned, even the Oracle of Omaha isn't infallible. What can we learn from his acknowledged investment blunders? The Dexter Shoe Company, for instance, often comes up as a famous example he himself talks about.
Indeed, even the best investors make mistakes, and one of Buffett's great qualities is that he's always been remarkably candid and open about his own errors. The acquisition of Dexter Shoe Company back in 1993 is one of his most infamous investment blunders, as he himself calls it, sometimes even labeling it his worst deal ever.
What went wrong?
He admitted to making two critical errors. First, he simply overpaid for what was, crucially, a declining business. Dexter Shoe was a U.S.-based shoe manufacturer that, it turned out, had no real sustainable competitive moat against cheaper foreign imports. Second, and this compounded the error massively, he used valuable Berkshire Hathaway stock as the currency for the acquisition, rather than paying cash.
Why was using stock so bad?
Because it meant that when Dexter Shoe inevitably declined towards worthlessness, the existing shareholders of Berkshire Hathaway suffered even more. They had effectively exchanged a piece of their wonderful growing company, Berkshire, for a piece of a truly bad, shrinking one, Dexter. If he'd paid cash, the loss would have been limited to the cash amount. Using stock magnified the pain significantly over time as Berkshire's own stock appreciated.
So what were the key lessons learned from that disaster?
The lessons were profound and really reinforced his core rules. Firstly, rigorous due diligence on the durability of competitive advantages is absolutely paramount. A strong brand name alone isn't enough if powerful external forces like globalization and low-cost foreign competition in Dexter's case are fundamentally eroding the business's profitability. Dexter Shoes simply couldn't compete on price, and its brand wasn't strong enough to command the premium pricing needed to survive.
Okay, diligence on the moat. What else?
Secondly, it emphasized the need for assessing industry risks more broadly. Even seemingly established companies can lose their edge quite rapidly due to seismic shifts in competition, technology, or changing consumer behavior. Buffett learned that he needed to understand a business's sustainable competitive position even more deeply, especially when investing in industries facing significant potential disruption.
And the third lesson about using stock.
Right. Finally, it highlighted the immense danger of using valuable assets, like Berkshire stock, to buy declining businesses. Buffett subsequently became much more cautious about using Berkshire Hathaway stock for acquisitions, strongly preferring to use cash whenever possible to preserve his existing shareholders' long-term value.
So he adapts and learns.
Absolutely. His adaptability is a crucial takeaway. Every mistake, like his later caution about management credibility after a different blunder involving Tesco, or his now permanent avoidance of capital-intensive, highly competitive industries like airlines after some painful early experiences, every single one contributed to refining and strengthening his investment philosophy over time. He genuinely treats mistakes as invaluable learning experiences that make him, and by extension Berkshire Hathaway, even stronger and more resilient in the future.
So bringing all this enduring wisdom right into the present day, how do these core principles apply to today's really rapidly evolving market, especially in a world so driven by technology? How do we identify companies with strong, durable moats now, given how incredibly fast things seem to change?
It's a great question. Identifying moats in today's market still relies on the very same core principles Buffett articulated decades ago. But you're right, the manifestation of those moats, and perhaps the speed at which they can erode, has certainly changed, especially in tech. Investors still look for the key quantitative measures, things like a consistently high return on invested capital, ROIC, ideally well above 15% sustained over many years. They look for strong gross and operating profit margins compared to peers, clear cost advantages if applicable, consistent revenue growth and growing market share, stability in earnings, strong free cash flow generation, low debt-to-equity ratios, and of course, intellectual property and brand strength remain crucial.
Can you give us a modern example? Maybe in tech.
Sure, let's consider NVIDIA, as a compelling real-world example of a company with a powerful modern moat, at least currently. NVIDIA has built a significant economic moat based primarily on its technological leadership in GPUs, graphics processing units, which are essential for AI and gaming. But crucially, it's also built around its proprietary CUDA software platform.
CUDA. Explain that.
CDA is basically a software layer, a parallel computing platform and programming model that allows developers to program NVIDIA's GPUs much more effectively for complex tasks like AI training. This creates incredibly high switching costs and really powerful network effects. Millions of developers and AI researchers around the world optimize their code, their models, their entire workflows specifically for CED. This makes it very difficult and time-consuming for them to switch to competitors like AMD or Intel, even if those companies offer technically competitive hardware sometimes.
So the software locks them in?
To a large extent, yes. NVIDIA also benefits from strategic partnerships with all the major data centers and AI companies, and it maintains consistently high gross margins, often exceeding 60% or even 70% recently, which is indicative of strong pricing power.
But is that moat truly durable, given how fast tech moves?
That's the million-dollar question, isn't it? It's vital to consider the contrarian take as well, because, as we keep saying, no moat is impregnable forever, especially in tech. The industry evolves at a breakneck pace. Competitors like AMD and Intel are constantly innovating, trying to erode NVIDIA's market share in GPUs and accelerators. Its heavy reliance on GPU gains makes it potentially vulnerable, perhaps, to entirely new computing paradigms down the road. Maybe things like specialized AI chips, ASICs, or even, in the more distant future, quantum computing, which could eventually render current GPU architectures less dominant for certain tasks.
And its partnerships.
Its dependence on strategic partnerships could also be a potential weakness if those alliances shift, or if major customers decide to develop more of their own custom chips, which some are trying to do. This NVIDIA example really highlights the continuous need for vigilance. A moat that looks incredibly wide and deep today might be under serious attack tomorrow. You can't just buy and forget, even with perceived moats in tech.
Are there practical tools investors can use to find companies with moats?
Yes, definitely. For example, Morningstar, the investment research firm, is well known for providing economic moat ratings. They categorize companies as having wide, narrow, or no moat based on their analysis of historical financial performance, the likely future sustainability of any advantages, and the specific sources of those competitive advantages.
So you can screen for companies with moats.
You can. And you can even invest passively through something like the VanEck Morningstar Wide Moat ETF, ticker MOAT, which holds a diversified portfolio of companies that Morningstar has identified as having durable, wide moats and that are trading at attractive prices relative to Morningstar's estimate of their fair value. It shows these principles are still very much alive, relevant, and being actively applied by professional analysts and investors today.
So as we wrap up our deep dive here, what's the ultimate enduring message from Warren Buffett's incredible journey for all of us, especially as we try to navigate today's complex, often incredibly noisy financial landscape?
I think the core takeaways are truly timeless, and they really transcend any particular market cycle or technological shift. First, it's about recognizing the profound, almost magical power of patient, long-term investing, letting compounding work its exponential magic over decades, not days or months. Second, it emphasizes the absolute imperative to focus not on fleeting market fads or quarterly earnings beats, but on a company's true intrinsic value, its durable competitive advantages, its moat, and the undeniable quality and integrity of its management.
To understand the business, focus on quality, be patient.
Exactly. Third, there's that absolute necessity to understand the businesses you invest in. If you can't explain simply how a company makes money and why it has an edge, then just don't invest. It forces you to be rational and informed, not just gambling.
And remember that Buffett quote?
Right. Remember Buffett's classic line, which remains incredibly relevant today. The stock market is designed to transfer money from the active to the patient. It's a powerful reminder that often doing nothing, just holding on to your great businesses is the best strategy, resisting the urge to constantly trade. And finally, maybe especially relevant today, in a constantly changing market, there's a continuous need to assess how economic moats might evolve or potentially erode. Maintaining that wide margin of safety and performing thorough scenario analysis aren't just academic exercises. They are practical necessities for navigating the inherent uncertainties of the future. It's really a philosophy that prioritizes common sense, discipline, and a deep understanding of business value over speculation, hype, and short-term thinking.
We've certainly navigated the depths of Warren Buffett's investment philosophy today, haven't we? From his foundational business like mindset and that powerful concept of the economic moat, right through to his nuanced approach to valuation and even the profound life lessons that seem to have shaped his unparalleled success. So, here's a thought for you, our listener, as you go about your day. Think about the companies whose products or services you rely on most. Maybe the coffee you drink, the phone you use, the stores you shop at. What are their hidden moats? And maybe more importantly, how durable do you think those competitive advantages truly are in the face of relentless innovation and constantly shifting consumer behavior? What truly stands out about digging into this is, well, how you might just begin to see the entire world and indeed every business around you through a much more insightful Buffettology lens from now on.